I've been frustrated lately losing my options trades in a tough market, so it got me thinking about the truly safest way to build $1 million retirement portfolio using options. A way that true beginners could feel confident executing and was free of the high risk trades. And by focusing on the math and probabilities, what I found is you can use the S&P 500 to model a path to $1 million retirement. So, in this video, I'm going to break down how this strategy works, why it's safer, and how you can start using it today. First, a question for you. Have you ever used a retirement calculator to see if you're really on track to be free from the working world, free to do what you want when you want? Now, maybe the timeline and final figure looked okay. Maybe you were horrified. The good news is that in this option strategy, there's a high probability of getting you to that $1 million mark, and it's extremely simple to use. In fact, if you were to just take $66,000, and I'll explain why this number is significant in a moment, invest it in the S&P 500, which is known as the SPY, a diversified investment generally accepted as the stock market, and let it sit for 30 years, you'd end up with $664,000. But when you do this using options, that final return jumps all the way up to 1.9 million. Now, obviously, there are some assumptions we have to make for the math to work, but they are not stretched or risky by any means. We are trying to build out $1 million retirement as passively as possible, and I want you to be able to go about your day without feeling chained to your investment app, checking every dip and spike. So to get this done in less time than it takes for your phone to update each month and to do it with as little risk as possible, we need to assume the following. The SPY average yearly return is 10%. We're going to use 8% to take inflation into consideration because, as much as you don't want it to, your money does lose a bit of value every year. Our timeline until retirement is 30 years. Give it the full 30, and at 8%, your 66,000 turns into 664,000. It's like planting a tree and letting it grow, except this tree multiplies your money by 10. Now, how do we go about breaking that $1 million mark? It's by selling options on the SPY, which just means you're getting paid for making a promise to buy or sell stocks under certain conditions. And I'll break these down for you. They are much simpler than they sound. When we add in the potential returns of selling put and call options on the SPY, we give ourselves an extra 4% per year. This is a return that is super conservative, takes inflation into account, and will be doable the majority of the time. So our total return becomes 12%, and poof, like magic, the retirement ends up just shy of $2 million, but it's time to hang up your working shoes. But how do you get this done without taking on too much risk? Let's break down exactly how you can do it without the late night market research. Nothing in life is risk-free. You could walk across the street tomorrow and get hit by someone driving looking down at their phone. But by using the SPY, which is like a giant fruit basket, we eliminate the need for picking stocks and the risk of them going to zero. If one of the apples in our basket does go bad, you'll still have plenty of other fruit. And if the SPY in the entire market goes down to zero, we've got way bigger problems than money to deal with. It'll be Mad Max Fury Road time. So if using the SPY keeps things risk-free, what about limiting the time commitment? Here's the beauty of this strategy. You only have to log into your investment account once a month. If you can carve out 10 minutes once a month, you'll be able to do this for yourself. And seeing the numbers will give you a dopamine hit that's actually useful because it's securing your financial future. Let's break down exactly what you'll need to do each month to turn 66,000 into $1 million over time. On day one, you have a trading account funded with 66 grand. This is the amount you need to make your first trade and get your money machine going so it just keeps working in the background. Step one is selling a put option right at the current price of the SPY. This means you agree to buy 100 shares of the SPY at your set strike price if it falls. Let's use a strike price of 660 and 30 days till expiration. Now, you get paid $13.39 per share or $1,339 to do this because there are 100 shares in each contract. Then you sit back and wait. On day 31, the price of the SPY will either have gone up or down, and you'll have one of two moves to make. If it went down and is now below 660 when the contract expires, you'll have to buy 100 shares of the SPY. Perfect though. You were paid $13.39, already adding 2% to your account value. Then you would sell a covered call option on the 100 shares that you own, getting paid again to agree to sell those shares at a higher price if the SPY moves up. I use the delta value of 30 for these calculations, meaning you'd have a 30% chance of having to sell your 100 shares at the strike price selected. And right now, a delta of 30 days out till expiration takes us to a strike price of 680 and pays $622. So selling this contract on day 31 would add another 1% to your account. Then you sit back and wait until another month goes by, or if the price of the SPY did go up, you're going to run scenario number 2 instead. If the price of the SPY moved higher and finished above 660, you would still keep the 1339 for selling the put on day 1, and the contract would expire worthless. You would not have to buy any shares of the SPY, and then you just repeat the process and sell another put expiring in another 30 days near the current price of the SPY again and get paid once more. No matter what the market does, you're collecting cash and setting up for the next round. No guesswork is required here. Running out to day 61 after another month goes by, you log into your account, see if you had to buy 100 shares of the SPY. If you did, you run scenario number 1 and sell a covered call. If you didn't, it's a repeat of scenario 2. And that goes on for 30 years or until you have $1 million to retire with. The math suggests that it really is that simple. And when I modeled this out with the help of AI, taking into account things like the current elevated market volatility, risk of major market sell-offs, and the frequency that you're going to be selling puts versus calls, it still noted a conservative return for the options part of this strategy at 8%. Now I've cut that number in half to 4% to account for inflation and to be on the safe side, and added it to the 8% return of the SPY to get to 12%, which takes us that $1.9 million figure. So if you're ready to take action, here's how you can get started with this today. If you want personalized help setting this up in your own investment account, book a private coaching session with me using the link below. If you prefer to go at your own pace and learn how to do it yourself, I created this next video walking you through how to do this inside the Interactive Brokers platform step by step.